Live from New York City this morning. Good morning, good morning. A bit of risk aversion out there right now. Equities down, yields lower, bonds rallying. Equities on the S&P negative by 0.7%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, the Treasury preparing to unleash a debt deluge, Moody's cutting ratings on 10 U.S. banks, and trade with China plunging more than forecast. We begin with the big issue. Here comes the debt.
There is kind of that perfect storm in the works right now. Treasury definitely surprising the market. This higher than expected amount of treasuries at auction.
Japan indicating that they're exiting yield curve control.
This fiscal stimulus and how prolonged it's been in.
It's uncertainty about the direction of interest rates.
We're going to get a CPI report.
Inflation is just one of the moving parts.
What's really going to be the bigger driver, in my opinion, is relative yields and demand.
Questions about will demand meet supply given the downgrade from Fitch.
The usual suspects will show up and they'll buy it.
I don't see the demand for treasuries changing.
We're backing up here in terms of yields because the supply is large.
There are a lot of factors that are coming together right now to push that long end of the curve higher.
Yields could actually move higher.
That steepening may continue to have some more legs from here.
Joining us now to discuss JP Morgan's Kelsey Barrow, PGIM's Mike Collins, two of the best in fixed income. Kelsey, first to you. Tons of supply through the week. 3-year today, 10-year tomorrow, 30-year on Thursday. Do you think we'll take this supply down without any problem?
Yeah, so we're going to be watching the auctions very carefully. I think there's a couple things to note. You know, each auction, you have to assess who are the marginal buyers going to be at that incremental auction and what's going on in the background. And right now, of course, we do have CPI on Thursday, so I think it would be a little premature for me to say that for certain the auction is going to go a certain way. But I think if you take a step back, what you've seen so far this year is that investors have been meeting the demand at the auctions. End user demand has been rising over the course of the year. So we think generally demand is going to rise to the occasion. And ultimately, the bigger driver of the market is going to be those fundamentals and that inflation report later in the week.
Michael Collins, let's go through the numbers. 42 billion, 3-year notes today. Later on tomorrow, 38 billion, 10-year notes. On Thursday, 30-year bonds, $23 billion worth. Are the buyers going to turn up, Mike?
Yeah, they're definitely eye-popping numbers, Jonathan, when you think about it, even in the context of the size of the global bond market, right? The U.S. government is constantly in the market borrowing money, and I think the demand will show up. You know, as Kelsey said, supply has historically been a lousy measure of interest rates, of the level of yields. It's really the fundamentals. It's about growth, which we know is slowing. It's about inflation, which we know is moderating. Of course, it depends on whether it settles down at 2 or 3 or 4. Our guess is 3. And it's about the path of the funds rate and the term premium. So those are the drivers. Our guess is, hey, anything in the 4s, especially out on the curve, 10 years and out, is a buy. That's what we've been advising our clients, and you've seen some resistance up at those levels.
Goldman agrees. Right now it is a buy and it's getting bought. Yields are lower by 8 basis points on a 10-year, 4%, 30s, 418. We're down 9 basis points there. Kelsey, Goldman say buy because they're not persuaded by the reasoning for the sell-off last week. Can we start there? Can you diagnose the sell-off of last week? What was that about?
Yeah, so I think there was a confluence of factors that were driving the sell-off last week. We had the debt downgrade, we had the Bank of Japan, we had the refunding announcements, but I think it was also a function of positioning. Some lazy longs out there that stopped themselves out, some new shorts getting added to the market. But ultimately, we would agree with Mike, we would agree with the analysis that you read earlier that there is value in longer dated yields at this point. I think it's pretty notable that we have run up against 4% on the 10-year yield 4 times in this cycle, and at every single one of those times, we failed. We failed to trade sustainably above 4%. So we're testing that again right now. But when we look at the path, we expect that the Fed is likely done with the rate hiking cycle. We agree that growth is moderating, inflation is trending downward. And so ultimately, those are going to be the drivers of lower yields as we turn to the second half of the year.
More downgrades this morning, this time from Moody's on 10 regional banks, pointing to higher funding costs, potential regulatory capital weaknesses, and rising risk tied to commercial real estate loans. We've heard a lot about this. Moody's this morning. Sonali Basak turning the volume up on the conversation.
Absolutely, because obviously these banks have had a lot of pressure. And what Moody's is saying broadly, we know. We know that there are commercial real estate pressures. We know that there are funding pressures. What's even more surprising, and you see it in the market now, John, is the ones that are under watch. These are larger, mid-sized banks. We are talking about U.S. Bancorp, one of the largest regionals here, facing the biggest drop in the market right now. There are idiosyncrasies in Moody's report. Remember, U.S. Bancorp bought MUFG Bank, MUFG Union Bank, and that has led to a lower level of capitalization. So that's why you're seeing that bank decline more. For BNY Mellon, State Street, Truist, the unfortunate thing about the Moody's report is they say an upgrade is unlikely for a lot of these firms. The silver lining for these banks, however, is contrary to what the market would think, is this idea that the longer-term capital requirements are actually a net positive for these banks. So even with these short-term pressures, there's an idea that this regulation that a lot of people thought would really stifle the banks are actually good for the credit ratings for these banks. Now, another thing that's a problem here, should these banks be downgraded, the counterparty risk means it's more expensive for these banks to do business. So it's kind of a vicious cycle, and this is the problem at stake. To your point, there's been 10 banks already downgraded. These are kind of in limbo here, which is why you're seeing such pain in the market. But again, a lot of these problems were broadly known. The ratings downgrade just adds another issue to the top of the pile.
Sonali, let's squeeze in one more bank. Goldman. I have no doubt you're going to be talking about this throughout the day. More exits at Goldman Sachs. Who's the latest?
John Rogers, the chief of staff here to the board, a very long-standing confidant. Remember, Goldman has recently added another addition to the board, and that is Tom Montag, the longtime Bank of America executive. There's a big change here in the composition of the board this year with John Rogers, historic figure at Goldman, stepping down, as well as Tom Montag coming on. So it's really changing the shape of Goldman in a way that most of the public doesn't even realize.
Stock is down 1%. For Goldman Sachs. Sonali, thank you. Thanks for that. Let's turn back to the downgrade from Moody's on those 10 lenders. Goldman, not one of them. Mike Collins, 3 reasons. Higher funding costs, potential regulatory capital weaknesses, rising risk tied to commercial real estate. Mike, all known knowns. We know all this. I'm just wondering how concerned you are about those 3 issues at the moment for US lenders.
Yeah, I mean, as Sonali mentioned, the regulatory capital requirements, which are going to get tighter, right? Regulations on these regional banks are going to tighten. That's actually a benefit for bondholders ultimately over the long term. We've actually liked the banks, as you know. One of our biggest overweights in our portfolios are the big money center banks, which have been heavily regulated. Now the big super regional banks are going to be a little more tightly regulated, and that actually is a tailwind for bond investors. So if these things underperform, if their credit spreads widen, we're typically stepping in and buying them.
And Mike, are you confident that the problems of March are behind us?
Yeah. I mean, we've screened, Jonathan, thousands of banks throughout the U.S., and you can pretty quickly come up with a short list of banks that have a big duration mismatch, have big exposure to commercial real estate, and have a disproportionate amount of that exposure to office, right? And a lot of the big super regionals that Moody's mentioned today in the report really aren't as susceptible to some of those big risks. So we're pretty comfortable over the long term that they'll be survivors.
Kelsey, do you share that more constructive view on a financial system?
Well, certainly the issues that are being highlighted by the rating agencies are known knowns, as you described. But I think just taking a step back, where we've been skeptical in terms of market pricing this year is this idea of a soft landing. Now, a soft landing is possible, but the track record is not there. More likely than not, the Fed is going to engineer a hard landing, not a soft landing. That's what their track record shows. And I think it's interesting, look back at what financial markets and Fed officials were saying in 2000 and 2006, which were hiking cycles that ultimately ended in recession. You look back at what they were saying, they were talking about the same thing. They were talking about soft landing. I was looking at a Bloomberg article written in July of 2000. Cleared for soft landing was the title. Ultimately, just a few quarters later, we had a recession. So yes, these are known knowns, but we do think underneath the surface, there are cracks forming more broadly in the economy because of just this unprecedented amount of tightening that we've seen from the Federal Reserve and central banks around the world.
Kelsey, do me a favor, send me an email later with that article because I'd love to read it. We're reading the same thing again this morning. This time it's from Patrick Harker of the Philadelphia Fed. We may be at the point where we can hold rates steady. Mike Collins, he said this: we can hold rates steady for a while. The US economy is on a flight path to a soft landing. Mike, I know you share the more constructive view around all this, but Mike, what is a soft landing? It's so poorly defined. What is it?
You know, it's really averting a big recession, right? It's averting, a big spike in credit defaults by consumers and companies. It's avoiding, an unemployment rate going into the sixes, right? It's avoiding, earnings going down 10 or 15% across the corporate sector. I think we can avoid that, right? I'm definitely in the camp that the hard landing scenario is very low probability here, but to Kelsey's point, the Fed could screw this up, right? Our view is they're going to keep rates longer than what's priced in. So we're actually short interest rates in the very front end, thinking of those like 2 and 5 years, maybe inch higher toward that 5.5% funds rate. But man, they could screw this up. If they keep that funds rate too high for too long, as inflation falls, you get this thing that people are calling passive tightening, right? Where the real rate gets higher and higher, and it does start to weigh, not only on banks, but on all kinds of borrowers. So the longer they keep that funds rate high, the better chance of that hard landing.
It's a really intuitive concept. It was explained by President Williams in an interview with the New York Times earlier this week. It makes sense. I understand all that, Mike, but the risk they run if they signal that maybe it's time to cut interest rates, exactly for the reason that you described. You may send the wrong kind of signal and then trigger a premature easing of financial conditions, which leads to a reacceleration in inflation all over again. Mike, how close are we to running that risk?
Yeah, that's why they're probably going to keep rates longer than what's priced in, right? Because they don't want to take the risk. They don't want to give the markets the green light to go ahead and shoot risk assets higher. They want to make sure inflation doesn't rebound, that this disinflation isn't transitory, that they don't make the same mistake on the way down. So I think they're going to err on the side of caution. They're going to err on the side of keeping rates higher, keeping policy tighter for longer. I think that's probably the right thing in the near term, but we all know, as Kelsey said, that typically ends badly. My guess would be that they keep rates in the fives for a longer period than what's priced in, and then at some point in the next 12 to 24 months, they're not cutting 50 or 100 basis points. They're cutting 200 or 300 basis points.
That's a big call. Kelsey, final word?
Well, I would just say that when we think about it right now, we think that the Fed is sufficiently restrictive. And so that risk that you were just asking Mike about in terms of are we at risk of the Fed pivoting too quickly and causing the economy to reaccelerate? The San Francisco Fed has a proxy Fed funds rate, which is essentially a measure of policy restrictiveness that goes above and beyond what the Fed funds rate itself is telling you. Another way, essentially, of looking at real rates. And that level is at 7%. That's the highest it's been since the early 2000s. So essentially, no, we're not concerned about that. We already think policy is restrictive enough to get the output that the Fed wants, slower growth and lower inflation.
Kelsey, stick with us. Kelsey Ferro with Mike Collins. Coming up on this program, China's recovery, losing more steam.
Import is surprising, and that's really bad because I think it just reflects the domestic demand weakness and the weakness of the consumer even more. Generally, I think it's pretty negative news.
Trade data out of China coming in a lot weaker than expected. That conversation up next.
Import is surprising, and that's really bad because I think it just reflects the domestic demand weakness and the weakness of the consumer even more. Also, the manufacturing sector affects industrial production, and that obviously is impacted by both domestic demand and exports being very weak. Some of it might be producer prices and input costs coming down as well, but generally I think it's pretty negative news.
Here's the latest negative news. China's economic recovery taking another hit. The nation's trade plunged more than expected in July, with imports falling 12.4%. Exports seeing their worst decline since February of 2020. Damien Sassoon, was it that bad?
Yeah, it was. No, and really for me, it's foreign companies operating in China, which comprise roughly a third of all of Chinese exports. They're down 14% versus 3% year to date for the broader, for broader exports, which just says it's foreign companies, it's the Mitsubishis, the Mazdas of the world that are scaling back their operations, and that's what's hitting the export side of the equation. On the import side, as your guests rightly point out, it's all domestic demand, which is falling off a cliff. Just today, we're seeing what used to be the largest seller of contracted property, Country Garden, potentially defaulting on another 2 bonds. So we've got property woes that are still kind of taking the market by storm, Jonathan. So look, we had some bad base effects certainly going back a year ago when China was, or Shanghai was emerging from COVID, but the data is still pretty weak.
A different commodity story in the mix as well. The team here at Bloomberg, Damien, as you know, reporting the following, and I think it's worth highlighting. The value of crude oil imports fell more than 12% in the first 7 months of 23 from a year ago. The volume of crude oil actually jumped by around 12% in that time. Is there a commodity distortion in the numbers that we looked at this morning?
And we've been picking that up in the PPI data. We're going to get inflation data overnight, Jonathan. So we're going to have probably for the first time since the end of 2020 a decline in both CPI and PPI in China. And what does that mean? It just means that these deflationary pressures are really taking hold. It's bad for profits. It's bad for profit margins. And China, I'm talking Beijing here, Jonathan, has really not stepped up with a willingness to support the corporates who are operating within China. I think that's a real issue there.
We talked about this morning. Now, we both know you can hardly talk about recession in a country that's set to generate 5% GDP growth. Are there elements of a so-called balance sheet recession starting to grip this economy? Do you see any of that taking place, Damien?
Absolutely. And it's really the fact that they just don't have anywhere to park their wealth. I mean, anyone there, will tell you, the middle class especially, that they used to park their wealth in property. You can't do that any longer. You're not seeing the equity market pick it up. So what do you do with any excess cash on hand? You sit and you hide on it, and you basically keep it under your covers. And I think that's what we're seeing. There's just no demand for really soft goods or goods more generally speaking. Now, on the services side of the equation, you have seen tourist revenue, you have seen restaurants and motion pictures and all that stuff pick up to some extent, but it's just generally a very, very weak environment for consumption in China.
Damien, thank you, sir. On the latest in China and more broadly EM over the last few weeks, big conversation for us as they begin to cut rates in places like Brazil, Chile and elsewhere. Kelsey Barrow, Michael Collins back with us. Kelsey, your view on what's developing in China right now. We know it's been worse than expected. How bad is it?
Yeah, so our team in China has had a very prescient call, very skeptical on the reopening trade for China this year. And so far, it has been very disappointing. And I think from the perspective of a global investor, what the key takeaways are is that you cannot rely on China as an engine of growth that's going to pull up any other country or going to push inflation higher. If anything, they are exporting disinflation to the rest of the world. Now, one area, though, where this creates opportunity, a trade that we've really liked this year, EM local debt. You mentioned Chile and Brazil, 2 central banks that have started their rate easing cycle. That's going to be easier if commodity inflation is coming off the boil. And I noticed today copper is down about 2%. So this is going to have implications for global inflationary dynamics.
Mike, do you like the same trade?
Unfortunately, yes. I hate being in the same trade as everybody else here, Jonathan. But it's this macro world we're operating in, and our view has been similar on China. This is not your father's Chinese recovery, right? Where they import commodities, they bolster all the emerging markets, and they export cheap goods to the rest of the world. That trade is over. That's what happened over the last 30 years. They're relying on a consumer that not only wants to get their money out of the country, they want to get their families out of the country, right? It is a consumer that's really stretched. So all of the stimulus we're seeing out of China is really just pushing on a string that does weigh down global growth. It does weigh down, global inflation. And ultimately, these really high interest rates all around the world, including some of these developing countries, are probably going to be a lot lower in a year from now.
Mike, just how unsynchronized is the global economy at the moment?
It is. The U.S., you're seeing the global manufacturing recession, and you're seeing that in the Chinese numbers, right? But in the U.S., you're seeing a manufacturing renaissance to some extent. Europe is always closely linked to China. So as China weakens, Europe weakens, and you are seeing that play out. Emerging markets writ large are struggling a little bit. You're seeing the whole leisure sector, as Kelsey mentioned, kind of booming all around the world, the reopening trade, whereas you have a manufacturing recession. So it's not just country by country, it's sector by sector, which creates a lot of relative value opportunities for folks like us to rotate into the right parts of the world.
Kelsey, a word on that, please, just to finish.
So we agree, and it is always challenging to feel like you're in the consensus here, but we've seen a variety of different stories happening throughout the sector. So in terms of being a credit investor, an investment grade or high yield, it's certainly important to understand that the business cycle is not all humming at the exact same tune throughout these different sectors. Areas where we've seen a lot of strength that you've mentioned, leisure, hospitality, but at the same time, there are areas that have been challenged for the past year or so and are really only just starting to recover.
Kelsey, wonderful to catch up. Kelsey Barrow, Michael Collins on the latest. Bank of America writing more recently about the same thing. Claudio Irigoyen writing the following. Growth revisions are starting to diverge. The US is moving higher, China lower, the Eurozone not showing signs of relevant acceleration, and going on to say, in DM, developed markets, the easing cycle is not around the corner, but some LATAM central banks have already started cutting. It's not synchronized at all. Tons of relative trade opportunities that Michael Collins was talking about, brought about by some of this regional divergence. Equities at the moment on the S&P negative by 0.7%. Coming up the morning calls and later, DWS Group's David Bianco making a case for avoiding big tech. That conversation's still ahead. Your opening bell, 7 minutes away. There's a little bit of risk aversion out there at the moment. The S&P 500 negative by about 0.6%. That's the price action. Let's get you some morning calls. First up, the likes of Truist upgrading DraftKings to buy, $44 price target, seeing a sustainable path to profitability after earnings. Telsey Advisory downgrading Home Depot to market perform, pointing to a challenging macro environment and weakening housing market trends. And finally, BMO cutting its price target on Beyond Meat down to $13 after earnings, expecting limited sales growth throughout the second half of the year. That stock is negative by 18% at $12.56 in the pre-market. Coming up, David Bianco of DWS Group recommending investors start diversifying away from big tech. That conversation up next. Your opening bell just around the corner. Snapped a 4-day losing streak on the S&P 500 in yesterday's session. This morning, we're losing again. We're down by 0.6% on the S&P. On the Nasdaq 100, down by about 0.7%. Pick your poison at the moment. Trade data out of China, not great. Downgrades at US banks. We're going into CPI on Thursday and PPI on Friday. There's your opening bell. Switch on the board and get to the bond market. Going into that data later this week, yields lower by 7 basis points on a 10-year, just in and around 4% throughout the whole of this morning, going into a ton of issuance through the week as well. Lots of 3-year debt coming to market later, the 10-year tomorrow, a 30-year auction taking place on Thursday. Classic risk off, risk aversion captured by an equity market that's lower, a bond market that's rallying, and a dollar that's slightly stronger against the euro. That currency pair negative by 0.5%, the euro 109.48, and crude commodities selling off too. We're down by 1.4% to $80.80 on WTI. About 35 seconds into the session, we're negative here by 0.6% on the S&P. UPS, the stock to watch at the opening bell, the company cutting its full-year profit forecast, saying the revision was, quote, primarily to reflect the volume impact from labour negotiations and the costs associated with the tentative agreement reached with Teamsters just last month. Abby has more. Hey, Abby.
Hey, John. And this is really interesting because moments ago, this stock had actually been lower in the pre-market, down by about 3%. But it seems that investors are recognizing the fact that this isn't the biggest surprise. The argument, the dispute with the Teamsters was highly public. publicized, the tentative deal that they have in place, it would make sense that it would cost money. So in some ways, they've thrown in the kitchen sink. They are blaming not just revenue, but also rising costs on the deal. So relative to cost rising, they're saying operating margins coming in by 100 bips, 11.8% from 12.8%. For revenue, they're taking in the full year forecast down by 4% to $93 billion from $97 billion. They are citing the volume impact from labor negotiations. You also have to wonder, though, this offers a nice cover for the post-pandemic trends that we've seen out of consumers shipping less, buying less off of the internet, perhaps with inflation, buying less overall to some degree. So whether it is the labor disputes or the consumer definitely taking it in. But now the stock is down slightly, so investors still trying to figure out what this means. Package volume did slide in the quarter that was. Underperforming on the year to the S&P 500, John, up just slightly on the year. The S&P 500, of course, up about 17%. Company still has their work cut out for it. The stock has been stuck in a range between about 160 and 200 for more than a year.
The stock is all over the place this morning. Abby, thanks for that. It's about 2 minutes into the session, we're negative here by 0.9%. Tons of confusion. The South Side trying to find some clarity. This is from JP Morgan reiterating its neutral rating on the stock after earnings, writing this. Expectations were increasingly negative coming into the event, but it appears the Teamsters negotiation was more disruptive than expected, given the implied impact on volume and operating costs. We expect the stock to underperform after the longer-awaited guidance update. That stock is negative now by a little more than 1%. I want to turn to the financials. Moody's downgrading 10 US small and mid-sized banks. Higher funding costs, potential regulatory capital weakness and exposure to commercial real estate all cited, with Moody's saying collectively these three developments have lowered the credit profile of a number of US banks, though not all banks equally. And Shanali, there might be more to come.
There might be more to come because we know that there are almost a dozen banks also placed on ratings watch. And those are the ones to watch because they are facing a lot of pressure because of that uncertainty. They say not all banks are created equal, and they all have their own reasons for why they're facing such pressure. Northern Trust, for example, the relative weaknesses to Bank of America, and JP Morgan for its funding profile, or US Bancorp because of its most recent acquisition and capital levels. What does that mean for future bank acquisitions and capital levels as people try to merge, get bigger and safer in the middle of the storm? M&T Bank also one of the ones facing one of the biggest kind of drawdowns today, because you do see it as one of the largest mid-sized and regional banks here with more than $200 billion in assets. Currently, John, that is right under the threshold, about $50 billion under the threshold for the U.S. stress tests. But we know that these banks will face larger capital rules ahead. So even with Moody's saying that in the long term, these capital rules could be a good thing, in the short term, we don't know how long that overhang will be. And it's another blow to the KBW Bank Index, which has been down already 13% through yesterday. Some of these banks were just flipping to the positive and today face another day of declines.
There was some hope this rally would broaden out and reach the financials in a more sustainable, durable way. Shanali, thank you. The update there. Said this a few times this morning already. Rather like last week with Fitch and the Treasury, there are issues we already know about, and the downgrade just turned the volume up on the existing conversation on days like today, and we talk about it a little bit more. About 4 or 5 minutes into the session, we are negative here by 0.6%. I want to turn to media. Paramount's second quarter revenue beating analyst expectations, driven by a lift in its streaming business, while at Fox, fourth quarter revenue fell in line with expectations. Geetha Raghunathan of Bloomberg Intelligence joins us now for more. Geetha, what stood out for you?
Yes, I think the consistent theme, John, across the media earnings is we're having much better free cash flow numbers across the board. And I think part of that is, of course, it's being helped by lower content costs because of the strikes. But the other thing I think for Paramount especially was their pricing power in the digital product. We saw 47% streaming subscriber growth, and they pointed to 20% ARPU growth for next year. So good pricing power for Paramount as far as streaming is concerned. And you come to Fox, and again, you see good pricing power in the TV product just because of their heavy exposure to news and to sports. So even though we're seeing some pressures in the linear TV advertising business, we're actually seeing both of them post strong digital ad numbers. And so that's helping them recoup some of the losses on the linear TV side. So, you know, there is some bad news, but there's also plenty to cheer about at this point, at least for media.
Fox is up by almost 5%, Paramount up by close to 1 percentage point. Geetha, before you go, Disney, after the close tomorrow, Reuters out with some reporting saying that Disney is creating a task force to explore AI and cutting costs. Can you run me through what they might be thinking about?
Yeah, they're really looking here to cut down on their content costs. So remember, John, content costs for Disney is the highest in the industry, about $32 billion. And of course, a lot of that is sports, and there's not a whole lot that they can do there. But when it comes to entertainment programming, yes, you can use AI to kind of trim down those production budgets pretty substantially. And I think that's really what they're looking to do here.
How do you think people striking over in Hollywood are going to feel about that, Geetha?
Yeah, it's not going to go down well.
Not at all. Geetha, thank you. Geetha Raghunathan there of Bloomberg Intelligence. Beating a raise for Eli Lilly. Let's talk about that. The pharmaceutical raising its full-year outlook after its diabetic drug hit nearly $1 billion in sales in the quarter, comfortably topping expectations. Simone Foxman has more. Hey, Simone.
Yeah, and we're seeing the reaction in shares there, up 13.5%. Two major drivers for this stock today. First, a crucial study on GLP-1 drugs from Novo Nordisk. Their drug Wegovy, which is specifically designed for weight loss, reducing the risk of heart attacks and strokes by 20%. So it's not just for diabetes anymore. This is the first study linking weight loss and the reduced risk of heart disease. And that increases the likelihood that insurance will pay for these drugs. That's important news for Eli Lilly's drug Mounjaro. It's currently approved for type 2 diabetes, but it's likely to be approved as a weight loss drug later this year. Those strong results for Mounjaro in terms of revenue this quarter, substantially boosting the full year forecast by $2 billion, boosted earnings per share expectations for the full year to $9.70 to $9.90, up from $8.65 to $8.85. And in fact, the only drug that underperformed on Eli Lilly's shelf was Trulicity. Another GLP-1 doesn't necessarily perform quite as well as Mounjaro.
Simone, that stock is doing nicely this morning. Simone Foxman there on Eli Lilly. The broader market looks like this. 8 minutes into the session, not up quite as much as Eli Lilly. It's down by 0.75% on the S&P. On the Nasdaq, we're down by 0.9%. The tech story is the story of the year. Year to date, it's been absolutely phenomenal. DWS's David Bianco recommending investors look beyond tech and look elsewhere, writing this: we think it's important to consider diversifying away from the very large and concentrated growth premium at tech. We are underweight on tech and seeking less demanding growth stocks in healthcare, select industrials and consumer staples. David Bianco, I'm pleased to say, joins us right now. David, wonderful to catch up with you. It always is. Let's start from the top.
Morning.
Earnings relative to last year, not great. Earnings relative to expectations, pretty decent. What is the more relevant benchmark for you and the team?
The absolute level of earnings, which will be $53 and maybe 75 cents for the second quarter of this year, which will be down 3 or 4% from last year. Perhaps more importantly, earnings are flat against 2 years ago. And we've had a lot of inflation over the past 2 years. So the real earnings growth is quite negative. I won't even get into it, but earnings quality is concerning as well. But for those who were talking about beating expectations, most of the expectations were beaten only because the estimates were cut at the last days before reporting. Long story short, earnings are going to be flattish, probably well into next year. And that's even assuming that we don't slip into a recession. This is a difficult environment for profits. It was a great environment for profits in late 2020, early 2021, and this is just going to be a long digestion before we see healthy earnings growth again out of the S&P.
David, I hate to pick on one single name. I'm certainly not an Apple analyst, but it is the biggest weighting on the S&P 500.
That's right.
And I think it serves as an example for the broader story that you and I can discuss. There's a name that is posting negative growth, is still up double digits year to date, and it's the biggest weighting on the S&P. David, what's the takeaway from a story like that one, without getting into new iPhone launches, etc.? But we're talking about multiple quarters of negative growth, trading at a 30 multiple, 30 times earnings. What's that about?
Jonathan, you make a really good point. I mean, Apple is the biggest company in the index, but it is probably representative of what's the thinking is and what I'm concerned about in the equity market. Earnings growth is flattish. Sure, there will be a return to healthy earnings growth probably next year. But in the meantime, look at the valuations with a name like the one you said being at about 30 times this year's earnings, and the broader S&P 500 being about 21 times earnings. But even if you exclude tech, energy, and financials, the S&P is still a little bit more than 20 times earnings this year. So I want to ask the question, if you're bullish now, why weren't you outrageously bullish over the past 10, 12 years. There's either something wrong with valuations and investor sentiment right now, or there's something very wrong with it over the past 10 years. Look, I think people were too bearish for a very, very long time, and they're trying to make up for that by being bullish now. But now's just not the right time for that. And it's not a Goldilocks economy. I would argue it's kind of a long trek through a dark woods for a lot of corporate America, and especially smaller companies, because the profitability growth is going to be hard to come to for another few quarters. So, look, I think it's been a giddy summer for the equity market, and it'll be back to reality in the autumn and into year end. This is why I think we're going to have a correction. I think tech deserves to be part of that correction. But my biggest concern at tech is really hardware and semiconductors, less so software. But yeah, the hardware, including the name you mentioned, and the chips war. The global chips war is real. There'll be a lot of CapEx spending there. I'm not sure this is going to work out also wonderfully for shareholders.
Let's get to services. You like select consumer industries. What we've heard so far in earnings season, and I know this is highly selective, it's cherry picking, but I'll pick two. JetBlue, Southwest, two airlines, basically flagging that domestic demand might be flagging. Now, David, I wonder whether we're learning anything about domestic pricing power in the United States of America. Is it fading in certain select industries?
It is fading. It should be fading. And yet, in many cases, the costs, particularly labor costs, are still high. I mean, you talked about unions, and these are hardworking people. I mean, and they work on site, not from the living rooms. So, I mean, I don't begrudge, their angst, their real earnings power has been eroded by this inflation. So I think what you're going to see is that a lot of service industries are going to slow down on the volume growth, slow down on the pricing power, and yet, there'll still be some pass-through of rising costs. So, we have argued leaning towards services and away from goods manufacturing, but we're trying to get more selective in that and recognize that, well, there's probably some more upside on restaurants, quick serve, but I think many other services are fully valued. And then we're looking at things like industrials and healthcare, aerospace and defense, electrical equipment, and really all of healthcare, whether it be pharma, biotech, managed care. I think this is an area with very good growth at very undemanding valuations. So let's look at healthcare, industrials. Our top pick for the year was the communication sector. Has done very well, but outperformed by big cap tech. But I think in the back half of the year, move away from big cap tech, stick with certain communication stocks for longer, but really add to healthcare and industrials.
David, really appreciate the update.
But be underweight.
Be underweight what, David? No, go on. David, please, complete the thought.
But be underweight equities overall. I mean, I'm always trying to find the opportunity in the equity market, show what we most like and what we least prefer. But I think right now, hardcore equity investors, they've done really well. Why don't you do yourself a favor and take advantage of the opportunities in the fixed income market? So move away from equities a little bit toward fixed income. I don't think you'll regret that.
David Bianco at DWS Group. David, do appreciate your thoughts. As always, sir, let's catch up soon. 14 minutes into the session, equities negative here. Coming up, Fed officials continuing to debate a pause.
Inflation does remain too high. There's still a plausible story out there that inflation normalizes in short order and the economy dodges additional pain.
The week ahead, CPI on Thursday, PPI on Friday. Mike McKee up next.
Inflation does remain too high. There's still a plausible story out there that inflation normalizes in short order and the economy dodges additional pain. There's a lot of talk over the last few weeks about the potential for what is often called a soft landing. Certainly last month's inflation read was a good one, and I hope it's a sign. Because, to be sure, the Fed's objective is not to cause a recession, it's to reduce inflation, in line with our mandate.
Richmond Fed President Thomas Barkin speaking earlier this morning on the heels of Philadelphia Fed President Patrick Harker saying the soft landing is quite plausible and it's quite possible at this point. The Fed speak coming ahead of the main event later this week. It's US CPI on Thursday, PPI data on Friday. Let's get to the team coverage. Mike McKee alongside Bloomberg's Ira Jersey. Mike McKee, wrap it all up for us. How many voting members of that FOMC now are leaning into the idea that it's time to pause?
Well, there's about two in the undecided camp. and there are two who seem to think that we need to raise rates farther in terms of voters. Pat Harker, as you just mentioned, this morning coming out and saying again that he thinks they can pause absent any alarming new data between now and mid-September. He believes they are at the point they can be patient and hold rates steady and let monetary policy actions they've already taken do their work. And then, of course, yesterday we had John Williams, the New York Fed president, who said that based on what he's seen today, the debates about do we need to go with another rate increase or not? And then Michelle Bowman repeating yesterday afternoon that she thinks they probably need additional rate increases. So you've got those three, and then Austin Goolsbee last week telling David Weston that he's undecided, but he thinks that they might need to pause and keep rates at a high level for a while. So nothing conclusive, but we do seem to be seeing some movement on the Fed to at least keep their options open for higher rates.
Ira, are we leaning into a pause here going into September 20th?
Yeah, I think we are certainly in September. I think November, obviously we'll get a lot more data before we get to the November meeting. Interestingly, the market is now pulling forward some hikes, some rate cuts for the first half of next year. Still pricing for a couple of cuts in the first half of next year. So this idea that the Fed could be on hold for a while, I think trying to define what a while means, whether that's 12 months or 18 months, which is not unprecedented in terms of the Fed being on hold, that could actually help the Fed's kind of goal here to get inflation down if we can price out some of those cuts, because pricing out, say, a cut next March is as good as putting in a hike in terms of financial conditions going forward.
Mike, what did Williams say about that in the New York Times? The ability to hold as inflation is falling.
Well, he echoed what Jay Powell has said and others, that as inflation falls, it pushes real rates higher. And you don't want to have a stealth tightening. So the Fed would look to cut rates, now not to zero again, but to slowly bring them down in line with falling inflation and rising real rates. So we're going to be looking at the yield curve with a lot more interest in the coming months. Once the Fed sort of lets us know they're on hold, then it becomes, as Ira's pointing out, a question of when do they start cutting rates, and that'll depend on how fast inflation falls.
Mike McKee, Ira Jersey, to the two of you. Thank you. On the latest on the Fed speak and the next Fed move. Still some data between now and then. CPI, of course, on Thursday. Another inflation print later on next month, I believe on the 13th. We have a payrolls print in between just to set up that debate on the FOMC. I want to talk about bank stocks briefly. The stocks are down by 3.62% if you're looking at the KBW Bank Index. Earlier on, in the last 24 hours or so, downgrades from Moody's on 10 names, potentially more to come. 3 reasons for it: higher funding costs, potential regulatory capital weakness, and rising risk tied to, guess what? We've talked about it a lot, commercial real estate. KBW Bank Index down 3.5%. Let's get you some more sector price action. Here's Abby.
And that downgrade by Moody's, John, certainly weighing on the mood music, as you know. The S&P 500 down about 1%. In fact, down 5 out of the last 6 days, down more than 2% over that time period. The worst stretch since March. So not surprisingly, we're looking at bearish sector composition. We have 6, at this time, 5 sectors down more than 1%. Kind of a random mix, too. Materials, financials, some of the tech sectors. Healthcare up 0.8%, really being held up by Eli Lilly, as Simone had been talking about earlier. And then if we take it over the last 5 days, well, we recently have been talking about breadth. Well, now we are looking at breadth to the downside. Real estate, materials, utilities, and tech. Those are the worst sectors over the last 5 days, John, weighing on the S&P 500.
Abby, thanks for that. The update on a sector price action, a broader index level story. We're down by 0.9% on the S&P. Near session lows on the NASDAQ, lower by more than 1 full percentage point. Up next, your trading diary. Banks are down, tech is struggling, the Nasdaq's down by 1.2%. Apple's negative for a 6th consecutive session, down something like 10% over those 6 days, the longest daily losing streak back to January of last year. Keep an eye on that name, as I'm sure you always do. On the S&P, we're down about 0.9%. That's the price action. Here's the trading diary. Coming up, the US Treasury selling $42 billion of 3-year notes at 1 p.m. Eastern. Wednesday, 10-year notes. Thursday, $23 billion of 30-year bonds. Plus, we'll get US CPI and another round of jobless claims. Fed speak from Raphael Bostic and Patrick Harker. And rounding out the week on Friday with US PPI and the UMich Consumer Sentiment Survey. From New York, that rounds out the morning for me. Thank you for choosing Bloomberg TV. This was the countdown to the open. Good luck for the rest of the trading day. This is Bloomberg.